The live intraday price for Opendoor Technologies Inc., Open, currently sits at $7.70, reflecting a decline of $0.08 or 1.03% in today's session as of the latest market data, with the stock trading in a range between $7.61 and $8.26. That slight dip might seem like a minor pullback after what has been a truly spectacular run-up from the lower single digits earlier this year. But what the casual observer misses is the significant underlying volume, nearly 55 million shares changing hands, which is a considerable spike in activity that suggests major institutional repositioning rather than just typical retail profit-taking. This heavy volume on a down day, following the stock's recent multi-bagger performance, introduces immediate tension between the expectation that this stock is simply a momentum play and the reality of complex capital flows that are now treating Open as a serious trading vehicle with deep pockets moving in both directions. The general market expectation for Opendoor has fundamentally shifted over the last few quarters. For a long time, the narrative was fixed on the company being a high-burn, capital-intensive iBuyer, perpetually dependent on cheap debt and a buoyant housing market. That model nearly broke the company when interest rates rose and home price appreciation stalled. The new expectation, fueled by the stock's incredible rally from its 52-week low of near $0.50, is that the company has successfully executed its strategic pivot, the so-called Opendoor 2.0, moving toward a more asset-light, AI-first, and agent-friendly platform that is capable of generating cash flow even in a challenging real estate environment. This expectation was reinforced by the company achieving its first positive adjusted EBITDA quarter in some time, a milestone that provided the initial catalyst for the move upwards. However, the reality is far more nuanced, and the intraday weakness on high volume is a perfect reflection of that underlying challenge. While the positive adjusted EBITDA was a psychological victory, the company still reported a net loss of $90 million in its most recent quarterly report. More critically, the contribution margin on homes sold fell to 4.4% from over 6% year-over-year, which management attributed to the burning off of older, lower-margin inventory acquired during the earlier, riskier operational period. This is the crucial point that forces a rethink. The celebration of Opendoor 2.0 has overshadowed the messy, expensive cleanup of Opendoor 1.0 inventory, and the market is still digesting whether the new, leaner model can consistently hit the 5 to 7% contribution margins management is targeting. Today's high-volume sell pressure may be large holders locking in profits after the multi-bagger climb, or it could be a more bearish signal from institutional traders who are placing a bet that the execution risk in the new model, combined with ongoing pressure from elevated mortgage rates, makes the stock's current valuation simply too rich. From a recent stock movement perspective, the rally has been intense. We saw the stock touch highs above $10 earlier this year, a move that was heavily amplified by retail enthusiasm on platforms like Reddit and X, Twitter, where its high short interest made it a prime target for a squeeze. The distribution of tradable warrants in November was a clear move by management to align shareholder interests and reward loyalty, and while well received, it also added a layer of complexity to the capital structure that requires careful reading by investors. The current consolidation around the $7 to $8 level is where the real battle is happening. Breaking below $7 convincingly on sustained high volume would suggest the momentum trade has peaked and is reversing, shifting the focus back to fundamentals. Conversely, a strong push above $8.50 with lower but still healthy volume would signal that a new higher base is being established, potentially catalyzed by positive news flow about the successful expansion of the agent partnership program. Let us be clear about what Opendoor does at its core. It created the iBuying concept, the process of instantaneously offering a cash price for a home based on proprietary data models, completing the transaction quickly, making minor repairs, and then listing the house for a profit. The company's goal is to turn a traditionally slow, painful, high-friction transaction into a low-friction, almost e-commerce-like experience. Revenue is primarily generated from the resale of homes, with ancillary services like title and escrow providing additional, higher-margin income streams. The critical shift in their business model as they navigate a higher interest rate environment has been to focus fiercely on inventory turnover speed and cost management, moving away from accumulating a large, risky book of assets and towards generating profit from transaction velocity and bundled services. Now we must address the elephant in the room for Opendoor, which is the sheer volume of short-selling activity. The stock has been a short-seller magnet for years, and while the high-profile retail-driven spikes create noise, the underlying short thesis is based on genuine concerns about the business model's viability in a non-accommodative interest rate environment. The latest available NASDAQ short interest data shows an extremely high short interest of over 127 million shares, which represents about 16.28% of the float. While this percentage is certainly high, what is more telling is the days to cover metric, which is currently very low, hovering around 1 to 2 days. For retail investors looking for actionable insights on this front, a low days to cover figure means that even though a large percentage of the stock is shorted, the current average daily trading volume is high enough that the short sellers could cover their positions quickly without causing a massive, immediate spike. In simple terms, the fuse for a true short squeeze is short. However, the short volume is not insignificant. Recent FINRA data shows that the off-exchange short volume ratio has been consistently high, often exceeding 35% of total volume on a given day, which signals continuous aggressive bearish betting. Prominent firms like various hedge funds or quantitative funds will often take these large short positions motivated by the belief that Opendoor's technology edge is overstated and that its ability to accurately price homes in volatile markets is inherently flawed, especially given the history of large inventory write-downs. Retail investors should monitor the borrow fee rates, which have been low, around 0.40% recently, indicating that it is not currently expensive for short sellers to maintain their positions, reducing the pressure on them to cover quickly. To stay informed, always check resources like the FINRA website or NASDAQ's short interest page for the bi-monthly reports, focusing on any sudden spike in the days to cover, which would be the real sign of an imminent short squeeze vulnerability. The ongoing conversation on social platforms is clearly focused on this short interest dynamic. Many retail investors see the high short percentage as an automatic call for a coordinated buying effort, a direct challenge to the institutional shorts. This is where clarity is essential. While retail buying can absolutely drive short squeezes, investors need to be realistic. Chasing a squeeze requires extreme caution. Instead, look for fundamental catalysts that might force the short seller's hands. The true actionable signal isn't the short interest percentage alone, but a combination of a rising days to cover along with a significant, unexpected positive earnings beat or a major strategic announcement that fundamentally alters the company's profitability outlook. Do you think the government will pass legislation in favor of the cannabis industry anytime soon, or is the housing market and mortgage rates the only thing that matters for Opendoor right now? Comment below with your thoughts. Looking ahead, the future outlook for Opendoor hinges entirely on a few critical factors, all tied back to the expectation versus reality framework. The expectation is that the recent appointment of a new CEO, Kaz Najatian, a former Shopify executive, will successfully complete the transition to a software-first operating model, making the company resilient regardless of interest rate volatility. The reality is that this transformation takes time, and the core of the business, buying and selling physical assets, is still susceptible to macroeconomic pressures, particularly high mortgage rates that choke off buyer demand. A future catalyst could be a surprise decline in the 30-year fixed mortgage rate, which would immediately bring buyers back into the market and accelerate Opendoor's inventory turnover, instantly boosting margins. Conversely, a major risk remains in the company's ability to predict regional home price movements. Any large, unanticipated correction in a key market could force further significant inventory write-downs, which would shatter the newly established positive investor sentiment. Opportunities lie in the successful scaling of the agent partnership model, which could significantly